How's it going? Hey, Donald, Dan, Maggie, how are ya? Who else is there? Is Dewin there? Dewin in the house? Hey, Rudy. Hey, Bobby. And let's see if Dewin is in the house also. Leon, Terry, alright. Esther, good to see you all. Alright, let's go ahead and get started. Boring day today, and I also missed the open, so I don't know if I saw that James had called the BFLY, but I wasn't around at the open. I actually didn't take a single trade until after 11 something, right? After, well, I got here at 10:45, I think. So, all right. At any rate, so couldn't really catch anything today, but we'll see. We'll see about tomorrow. Yeah, for sure, Dewin. Absolutely. All right. So there's two things that I'd like to go over today. Okay, two things. One is the question about that came up in the room about the AYI. When do you take the first sell setup? When do you not take the first sell setup, right? When you see, so what's a sell size? Sell setup is when you get a counter rally towards the declining 20, and then and you look to short it. When do I get in? As soon as it takes out the prior bar's low. When do I let it go and then look to get in it later? So we'll talk about that next. I mean, that would be the second thing. The first thing I'd like to talk about is those climactic stocks that sometimes Dewin oftentimes says that's a short, and then it keeps going, but it's really hard to do because it's down a lot and it's moving at the speed of light, and it's hard to jump in. So how do we do it? How do we do it? There's two ways. There's really three ways, but the first, so when you see a stock that's down a lot, but you can tell it still is lower, so the thing to do is to go to the smallest time frame and try and play it off of the 20 MA, or I use the 8 also for those power trends, or off the 8 is okay too. Let me see if I can project here, so give me a second and I'll show you what I mean. Okay, so here we go. This is from a course that I used to teach, but it's not gonna line up exactly as you can see. Maybe I can just I can fix it a little bit. So, but so I got a method for playing those pre-climactics is what I call them, but give me a second. Okay, so let's just say that looks good like that. Let me just open it up. Yeah, that looks decent. And let me take down the charts for now. Don't need the charts. All right, so first, what is a pre-climactic stock? Meaning a stock that hasn't yet gone totally climactic. It's you can see it on the chart. The stock is up a lot, but you can tell it's not done yet. So it starts to accelerate, but doesn't go totally vertical. That's pre-climactic. So it's not the initial grind up, but it's the explode, after it pops hard somehow, but not really, really hard that it becomes climactic. So this is the state of that I call pre-climactic, right? And the way to do it would be to go to, so let me just see here. So this is pre-climactic, when it gets really going, but it never accelerates, right? It never goes vertical. So the vertical part, that's climactic. That's already too late. The initial pop, that's not too late. You can get in it. But when it starts to print wide range bars and goes like vertical, at that point it's too late to get in it, because it can flip on a dime. But as long as it's it's sped up. So it's sped up. It's not rallying at the same speed as before, but it's not vertical yet. That you can do it. Now, how do we do it? We do it by going to the the smallest time frame possible. Let me see. Like, I can just show you this as an example. I'm jumping here from page to page. So you go to the smallest time frame possible where the stock is either respecting the 8 period moving average. You can also use the 10 or the 20. So in this case, it's the 2-minute chart, right? And you want to look to do it not after it breaks the low of the day, which is what we're usually tempted to do, is once it breaks low of the day, because now it's below everything, below the support, let's short it. It's too late by then. So you want to short if the stock is moving up with a higher high. Hold on just a second. Let me see if I can get that annotation tool. There it is. It's gonna mess up the. Let me see if I can hide it. Okay. So if the stock is moving, on the way down, it's actually moving down and then up, like so. Then obviously the mistake that you absolutely don't want to make is to short it under the prior low. Because then shortly after getting in it, it's going to bounce and you're going to get shaken out, because you're going to think, oh my god, that might be the bottom. So the first step is to make sure that the stock is not vertical. So here's the initial move. It's okay to speed up like so. That's not climactic yet. It's not okay to get involved in a short after the stock went vertical. So stock is down a lot. That's called a power trend. Okay, it drops a little bit more. That's fine. If it goes vertical, you can't do it. So this is what I call a pre-climactic. Now I'm not saying you can't get in it here too. You can, and the way to get in it while it's down a lot is by analyzing the small time frames, the 1 and the 2 minute time frames. That's it. You don't have to go check the 5, the 15, just the 1 and the 2. And ask yourself, is the stock stair-stepping lower? Like so, stair-stepping lower. Or is it counter-rallying and then dropping? So, or is it more like this? What is it? Does it have sell setups or breakdowns? Okay. If it's breakdowns, it's easier, because then you short it under low of the day, under the base breakdown, under low of the day. Okay. More often than not, it's not going to be this clean, this neat. It's going to look like this on the small time frame. Okay. In which case you do not short it after it takes out the lows. So again, if it's moving up and down, don't short it under the low of the day. Short it as it takes out the prior bar's low after a move up towards the declining 20 or 8, whichever move. You can use whatever moving average as long as the stock is actually responding to it. Okay, as long as the stock is responding to it, you can use it. So that's the key to doing these, is you gotta short it over here, gotta short it over here, but you can't short it under the lows. Now if it's stair-stepping lower, no problem at all, short it. Okay, under the base. So that's the first way to do it. Sometimes what happens is, let me show you. What happens is we see that the chart, my goodness, that's too bearish. It's never gonna bottom, right? This kind of chart, way too bearish. It's not gonna bottom, or it's very unlikely to bottom. It's like the VHC. Remember the VHC? When I said I don't think that's gonna actually bounce today, and it didn't, and it dropped so much more than I even expected, and it never bounced at all, because I could tell the chart was really bearish. It's gap disease, is when the stock gaps up and completely craps out. That's called gap disease. So if you suspect, wait a second, this daily chart is really bearish, okay, and the stock, which means any move up is probably gonna fail. So the second I'm looking for like a white thing to draw over, let's just use this one, a blank page to draw over. So if the stock does go climactic, and maybe, you know, but you already can tell it's probably not going to work because the daily chart is really weak. So don't short it unless it bounces. So if it bounces, comes back down and starts to base, then you can short the breakdown. So let me recap because I know it's confusing. What I'm saying is the first way to do it is to, again, you got to make sure it didn't go totally climactic, and then look at the smallest time frames, determine whether it's stair-stepping lower or counter rallying, and then take, you know, and then short either the breakdown if it's stair-stepping. If it's counter rallying, do the sell setup at or near the 20 MA, okay, on whichever time frame it's whichever moving average and whichever time frame it's responding to. Okay, that's easy. The second way is if you find the stock after it's already kind of gone too far, it's too climactic already, but you look at the daily and you say this thing is probably not going to work, so it bounces a little bit and then comes back down, then you can short the breakdown under low of the day. But the key is to never short it like so. Never short it without a bounce first. So if it goes climactic, this is what most people miss, which I learned the hard way too. So here it is. This is what a lot of people do. Goes climactic, totally climactic, but doesn't bounce and starts to base at the lows. And they think it's a short. It's not. It's not a good short. It comes in and goes right back up. Why? Because the stock has already run out of sellers. Everybody sold it. But if the stock goes climactic and it's not really such a good climactic and the daily is bearish and bounces and comes back down to the lows, bases at the lows, you can do it short because now you have a fresh supply of sellers. Those that bought it here, when it breaks low today, they're going to be forced to sell it, right? And so you can short it. So what I'm saying again is, look at those when you're evaluating whether to short a stock that already went climactic or not. There's three things to look for. One, ask yourself, is the daily really bearish and therefore it probably will continue lower, right? If the answer is yes, then look at the intraday. Did the intraday bounce after going climactic? I'm not talking about a climactic that bounced all the way back up. That's not a short. I'm talking about a climactic that bounced a little bit and came back down to the low of the day and based at the low of the day. If the answer is yes, it bounced, then you can do it. If the answer is it didn't bounce, it just dropped and based, then you can do it because it's usually going to be a breakdown failure. Because if it didn't bounce, it means people didn't step up and buy it. So when it breaks down, there's not much sellers anymore. And so it usually fails. It ends up being a breakdown failure. But if it bounces and it comes back down to the lows and breaks down, then you can definitely short it. So those are the two ways that I used to do. I really don't do anymore, which I call pre-climactic. Pre-climactic type 1, pre-climactic type 2. One is the result of a power trend that accelerates, but doesn't accelerate so much that it goes vertical. It just speeds up, right? And the other is the result happens after a stock goes climactic, but the climactic buy setup wasn't very good and the daily is really bearish, and then comes back down and bases at the low, in which case you can short the low of the day. So those are the two ways in which I do the pre-climax. When we switch to charts, a JM, we can look at, I closed out of my charts, that's why. I can look at the J and J if you don't mind. So got it, D-Win? But I'm happy to look at it. Just give me a minute if you don't mind. All right, so the GDX 180 on the monthly. To get in long, we would want to control decline to the 60 based on the daily being pre-climactic. I mean, this concept that I'm teaching applies to the intraday. I wouldn't want to be, you're not going to be scalping the GDX off off the hourly or off the daily to keep overnight. So this concept I'm using for intraday. If you can duplicate the same concept, apply the same concept to swing trading, power to you. but I don't, I think it's too risky if you get involved in something that's way up like that, like the GDX. Okay, and J&J, I'll come back to that chart in a little bit. Okay, D1, sounds good. So those are the two ways that I use to get into stocks that I think have way more to go, like the AI today, or some of the ones that you sometimes often point out and say this thing is probably going to be much higher still, but but then it's hard to jump in it because it's up so much. But those are the two ways that I use. All right, the other thing that I wanted to talk about was I think Donald was the one that asked. Donald, are you around? I think you were the one that, or was it T-Dog? I think you were the one. Yeah, I thought it was you. So the other thing that I let's see where it is. Should be the page. It should be over here. So this is something that I literally drew by hand. Literally 14-15 years ago, which is how do you get into the question is, here's the buy setup, okay, and here's another buy setup. How do you know whether to get into the buy setup as soon as, so where's the trigger for a buy setup? The buy setup triggers, so here's the stock moving up, right? And it comes back in, pretend these are red bars, doesn't matter. And then once it takes out the prior bar's high, that's your entry long. But sometimes it comes in and I decide to pass on it. And I say, no, let's wait for a secondary sign of strength, okay? SSS, secondary sign of strength. So meaning I let the first buy setup go, and then maybe I get another entry, base breakout, or I get a double bottom, or I get a higher low or something. But I don't do or I get a 1, 2, 3, meaning it moves up and then gives me a doji bar, and then I can do it as a 1, 2, 3, but I don't do it on the first entry. The way to determine whether the play should be taken off the on the first entry or not is by looking at multiple time frames. But I've said this before, which is a standard play requires no special, requires no secondary entry at all. So if the setup is picture perfect, okay, then it requires no, you don't even need to look so much at the smaller time frame. This one was picture perfect, but was pretty deep, so let's not use it. That's just a standard setup. What's a standard setup? A standard setup is when the stock, when you find a bullish stock and the pullback was clean and at the right spot. So you get a strong stock with three or more red bars in a row, and the bars don't gap into each other. You don't have any green bars ignored. You just have nice clean pullback, and the pullback retraces about 40 to 50% of the initial move. So from here to there, that's 100%. That's about 40, and it also it pulls back to support and or the rising 20. If that's the case, you can always just wait for that bar's high to get taken out, and then put the stop under it and take it, and not look at multiple time frames. But more often than not, the setup that you find on whatever time frame is not going to look perfect. It's going to be a little too deep. It's going to look, I don't know, it's not going to look perfect. It's going to be a little too shallow, meaning it didn't rally enough. It didn't reach the 20. It didn't, it maybe rallied only 1/3 of it, retraced 1/3. So how do you do it on the first entry? No, you don't. But if you're not sure whether it should be played on the first entry or not, then what I suggest you do is look at the multiple time frames. Mainly look at the time frame, the one time frame smaller than where the setup than the time frame where you see the setup. So if you happen to see a nice 5 minute buy setup, like so, then which time frame should you be looking at? You should be checking either the 2 or the 3 minute time frame, whichever time frame you use. But basically we want to go to the next lower time frame, okay? And make sure that if you're looking to play long, that the next lower time frame, it looks good too. So it needs to look good. What does that mean, looks good? It means it shouldn't be in a downtrend. When the stock is triggering on the 5 minute, it shouldn't be triggering into a declining 20 on the smaller time frame. These are the 3 scenarios that you can expect to see on the smaller time frame. So again, when we're looking at a buy setup, whatever time frame you want, 5, 15, okay, we're gonna go to the smaller time frame and check to make sure that the smaller time frame looks good. Looks good means it doesn't have a downtrend. A downtrend means lower highs and lower lows. If it does, then you cannot take it on the first entry. Okay? So what you have to do is, so if the stock is downtrending on the smaller time frames, what needs to be done is you have to wait for the smaller time frame to end the downtrend and do it on the next higher low. And hopefully it'll be off of the pretend this is the declining 20, it'll be off of the rising 20 on the smaller time frame, like so. Or at least let it pop and give you, let it pop and give you, let it break the trend and maybe give you a 1, 2, 3 or a base breakout or so. But you can't do it off of the first entry if the stock is in a downtrend on the smaller time frame. So you can, though, if the stock is in a downtrend on the smaller time frame and then the sell setup fails. Fails means the sell setup doesn't take you all the way down to the lows. So this is a little messy. I'd like to have a whiteboard. Can I use a whiteboard somewhere? Let me see. Should be a whiteboard. Let me see if I can use a whiteboard. Please, where is the whiteboard here? Because let's see. Should be a whiteboard in this app that I'm using. There used to be, but they keep moving it. And let's see. So where's the whiteboard? Hold on 1 second. What if I just went to the internet and typed whiteboard? Tools. Should be under tools. That's where it used to be. Okay, let me just get a whiteboard from the internet. Or let me see. I don't think if I use a Word document and use it as a whiteboard, will it cover it? Nope. All right, 1 sec. Sorry about that. 1 sec. Oh, well, this. Okay, let's get rid of this. And then. Let's do, this is an ugly whiteboard, don't like it, but let's do this one right here. See if this works as a whiteboard. Alright, it's good enough. Okay. So, okay, let me see if you can see. Oh, perfect, perfect. That's what I want. So, okay, so keep in mind, this is the pattern that we're trying to do. It's a buy setup. Okay. Okay. So keep in mind, this is the pattern we're trying to do. It's a pullback pattern, hopefully to the rising 20. Hopefully the pullback isn't this deep. That's a pretty deep pullback. And we're trying, and let's pretend this is the 15-minute chart. We're trying to make sure that the smaller time frame looks good. Okay. That the smaller time frame, either on the way down, it just has red bars. It just has like so, red bars, but doesn't have a downtrend. A downtrend means lower highs and lower lows. If the smaller time frame has lower highs, lower lows, like so, then you cannot take the first entry on the larger time frame. That's the first entry. You have to let it go. Okay? And you have, so if there's a downtrend, you have to let it go, meaning let it go without you being in it, and look to do the next entry. And hopefully the next entry will be like a higher low or a base breakout, whatever it is. But you can't do the first entry. Now, if the smaller time frame has a downtrend and the downtrend fails through a sell setup failure, meaning it goes up, comes in, you get a red bar, and then it pops. A sell setup failure means the stock didn't make it, the sell setup didn't make it down to the lows. It merely triggered and then the stock popped. Then you can do it on the very first entry on the 15, or the sell setup failure right here on the, let's say the 5 in this case, should be the 5. Because this, what you want to do is, on the smaller time frame, you always want one higher high, and one higher low. That's what you always want to have on the smaller time frame. If the smaller time frame is just, it's got multiple red bars in a row, no problem. You don't have any lower highs and lower lows. You don't have a downtrend. So you don't need to have a higher high and a higher low. If the smaller time frame has lower highs and lower lows, you want to make sure it has, before you get in it, that the smaller time frame has one higher high and one higher low. A sell setup failure, this is not a very pretty sell setup. So a sell setup failure would look like this. Would be lower highs, lower lows, right? Lower highs, lower lows, and then it pops like this. So a sell setup failure means you get in it over the pivot high, and that's already a higher high, and this low is higher than the previous low. So a sell setup failure gives you a higher high and a higher low. But a lot of times you don't get a sell setup failure. What we get is, you know, there's the downtrend. And then the stock just pops like so. Where's the higher low, higher high? You would have, this would be the entry, by the way, on the 15-minute chart. This would be on the smaller time frame, but that would be the entry. In this case, we would only have one higher high, but this low is lower than the previous low. Does that make sense? So you have to look at the smaller time frame and see if the smaller time frame has a downtrend. Okay? If it does, then you have to wait for the downtrend to end, for the stock to end its downtrend. And the stock can end its downtrend in, we've discussed 2 ways, but there's in 3 different ways. The first one is, here's the downtrend on the smaller time frame, is it just pops out of the blue almost. Usually that's where the 20 MA is on the 15 or the larger time frame. If there is no sell setup failure, you have to wait for a secondary entry or a higher low. Now we have, once it took out this high, we have a higher high. This is a higher high, and that's a higher low. If the downtrend, or if the stock ended the downtrend through a sell setup failure, meaning it didn't reach the prior low and just popped, you can do it right here long with a stop right here, or you can use the pivot low on the 15, which should be down here, basically. So that's the second way. The third way is when you have, if you have a downtrend on the smaller time frame and the stock accelerates. So let's say you have a channel and then the stock drops really hard below it. Then you don't have to wait for the downtrend to end. You can just pick it up as soon as it takes out the prior bar's high on the smaller time frame. I'll give you an example. I'll show you an example right now, actually. So let me show you an example. I just need to open up my charts. Okay, this one is good. No, I just, let's see. How do I get rid of this? Okay, there it is. So here's the chart. So here's an example of what I'm talking about. But I didn't like it enough to do, so I didn't do it. So you see what I mean? It's selling off and then accelerates into the 20 on the 15. So if we go to the 5 minute you'll see the acceleration yesterday. There it is. I mean, a little bit of acceleration. And that was basically the best entry. If it accelerates below that channel. But the reason why I didn't like it is prior to the big drop, it actually tried to go higher and failed. So you see this? That's what I didn't like about it. But basically, you know, if the stock accelerates hard after being down into the 20 on the 15 and accelerates, so it's accelerated, this was a big wide range red bar, then you can do it off of the smaller time frame, the 2 minute, the 5 minute, just over that last bar's high. This is my favorite way to do it, but it's rare also. So it's down a lot. Here's the 2 minute yesterday, and accelerates as it gets to the 20 on the 15. See what I mean? Let me zoom. Let me just. So here it is. So if the stock had continued with this way, I would have, and then accelerated like over here. If we had these red bars over here, I would have done it with my eyes closed. But unfortunately, it popped over here, which triggered the 15-minute buy setup, and that's why I passed on it yesterday. But that would have been amazing. Imagine getting into the play over that bar's high, or let's say over this bar's high, 25.70, stop under 25.59, 58, and it moves dollars or whatever, $1, 10-hour play. So that's my favorite way to play the 15-minute buy setup, is to look at the smaller time frame and see if the stock had accelerated below that channel into the 20 MA on the 15. You see what I mean? Then I just pick it up right here. I don't even wait for the downtrend to end. But oftentimes, but that's rare. Most of the time, as I said earlier, and I keep repeating myself because I know, you know, it's a little complicated. Most of the time, it doesn't happen like this. Most of the time, you just get a downtrend on the smaller time frame, and you want to make sure if there is a downtrend, that the downtrend ends before you get in it. And the downtrend ends in 2 different ways. In 3 different ways. It either accelerates, right? And then in which case you just pick it up off the lows and you don't wait for the downtrend to break. You don't wait for a higher high or a higher low. Or if it just pops like so, in which case we would have just one higher high. We don't have a higher low. Then you have to wait for the secondary entry. You need to have a higher low. If the stock, you know, you have the downtrend, and then there's the sell setup, and then it just pops, doesn't reach the low of the day, then you can just definitely do it right here, long, stop right here, or stop right here, whatever you want. And then where you get it here, you know, the stock should have reached the 20, or, you know, very close to the 20 on the 15. So the play comes from the larger time frame, and you're using the smaller time frame just to finesse the entry, just to make sure that the smaller time frame is in alignment with the larger time frame, and to know exactly when to get in it. Okay, so that's one scenario. Second scenario, and the third scenario is when it accelerates, goes a little climactic on the smaller time frames into the 20 MA on the larger time frame. Does that make sense? So those are the 3 ways that I use for playing buy setups and sell setups. Okay, and so for example, the AYI today, I passed on it. I mentioned it, but I said it required a secondary entry. To tell you the truth, I didn't even look at the smaller time frame, but I can tell usually what's happening with a smaller time frame just by looking at the chart. So over here, I mean, that's a pretty big move up. Okay, now you might say, well, isn't it at the right retracement level, you know, 40%? Yes, it is, but I'm sure that put the smaller time frame in an uptrend. So put it above the 20. So you see that it's above the 20, in which case now there was a way to do it here, which was under the SPARS low, because it accelerated a little bit. You see how it accelerated and the volume spiked into the 20 on the 15, then short right here. But as long as you're okay with getting out of the 20, or you just wait for it to reach the 20, try to bounce off the 20, and if it fails, you can short it under the SPARS low, stop right here or stop right there, whatever you want. How, you know, if you're aggressive, you use the lower high. Now I don't remember what it did. Now it's got a good setup. Check it out. Now if you didn't do it over here, short, stop right here. Now here's the play. Short, stop. But I think it went higher. It didn't go lower. Yeah, and it never triggered basically. You got it? So I hope that makes sense on the AYI. And just in general about the, how to use multiple time frames to perfect your entry on the pullback play or the buy setup, sell setup pattern. Okay, I hope it makes sense. Now I want to go back to the JNJ. So the question was, we were talking about the climactic stock, and you said it's like JNJ today. Is that what you said, JM? And let me see what you said. So JNJ today, I don't see a climactic move on the JNJ. Maybe, should I be looking at a smaller time frame? Oh, in after hours. Oh, okay, yeah. I don't get after hours. I do, but I don't know how to do it. Let me see. So JNJ, it's probably up in the after hours. Yes, it is. Yeah, I don't know. Sometimes I get it, sometimes I don't. So exclude data after 4 p.m. So now I'm supposed to get it. Nope. I don't get it. The after hours. And let me see. Start. Include. Maybe that's the one. Oh, that's the one. So in this case, so okay, there was a nice breakout on it over here, and the stock had already been running up. If you include also, this only shows, I guess, does that only show the pre-market? No, that's during the day. So in this case, it was up a lot and then based, and then, it up a lot, came in, went back up, based, and you play the base breakout. So yeah, that would be like pre-climactic type 2. It's not the first one where it's up but not vertical. In this case, it popped, came in, went back up, based, and then the base breakout. But in the after hours, you simply can't do it, because the way they pop after the close, when they pop, it just happens at the speed of light. It's like, it's very rare where, it's been, I might have caught a play in the after hours like this one, or 2 or 3 times in my entire career, because they just move so fast that it's really hard. But yes, I get the point. Good point. It's not perfect. It's not a perfect example, but it's a good point. So I get it. All right, AI. Let me now reopen the page so I can get rid of the post-market data. And then AI, another thing to note, it opened below the doji. Yeah. And then D-Win, after a while, like, you're already good at this, which is identifying stocks that are not going to bounce, or that if they bounce, they're very suspect, that the bounce should be short-lived. You're already good at it. So now the next thing to do is to take it a step further and see if you can figure out a way to take advantage of them. So that's the next step for you, because I think you're pretty darn good at identifying bad daily charts, basically. Bad daily charts, right? So now, can we play it on the smaller time frame? And the answer is yes. So in this case, check it out. Is that climactic? That's not climactic. That's not climactic. It may be down a lot, but that's not climactic. Over here, it's starting to go vertical, so I wouldn't touch it. That wide range bar, now I wouldn't touch it, because it can bounce. I know it continued lower, but it can turn on a dime, so it can be quick. Now it's not climactic anymore either. So over here, after that wide range bar, starting to go climb. No, I wouldn't touch it. Over here is okay to do. So how do we do it? We're gonna go to the smaller time frames and take a look. I haven't looked at it, so I go to the 1 and the 2. Now, on this platform, I'm just showing you one time frame at a time. My other platform is easier because I can see multiple time frames at once. But let's see if this looked good on the, and take a look. Perfect on the AI. Perfect. So, in terms of, when I say perfect, I mean no acceleration. This is lower when you have this kind of a trend, and you're very confident about the daily. That's lower. It didn't have like it didn't have clean counter rallies, you know, it didn't have clean pivots like this way, that like so. So, but the best way to get it is to basically fall in, if it doesn't have the setups, on any kind of pop towards the 20, and your stop goes above the 20. So any pop towards the 20, fall in, as long as you put your stop on the other side of the 20, because I don't see any good base breakdowns either. The problem with doing base breakdowns is you short, and then right after you get in, it pops. It already shakes your confidence, even if your stop was above the 20. Does that make sense? So in this case, should have been shorted on the rallies to the 20, but it didn't give really clean entries at all. I mean, I don't see clean entries. So if it doesn't give clean entries, pivots, or base breakdowns, here's the third way to do it. Here's the third way. Fall in. As long as you fall in the right area. So fall in towards, as close to the 20. Now, I also recommend using the 8. So let's just change the 200 to the 8 here. Okay? And see if it was trading off of the 8, because those power trends often trade off of the 8, not the 20. So that's the 8. So basically, or the 10 you can use. So off of the 8, but not really clean. Like we've seen much cleaner stuff than this, right? So either off the 8 or the 20. But the key thing is, if you see a nice trend like this, you can just get in it anywhere you want, almost, as long as you give it enough room so that your stop is above the 20, so you don't get shaken out. And then you can add to it also. You can add to it. I don't recommend continuously adding without taking some, because then if it flips on you, then you're gonna give back everything and some more. So I don't recommend that. But so what I recommend doing is, after every drop you take some and then you reload. You take some and reload. Okay, meaning, let's say you have 2,000 shares, you close out of it half, 1,000, and if it goes back up towards the 20, you can put the 1,000 back on. It drops again, take another 1,000, wait for it to go back up, and then so this way you always have 1,000, or or however many, or 500 or 200 or 100. But you don't keep adding without taking any profit at all. All right, so that's the AI today. Pretty nice, but the smaller time frame wasn't like, it didn't give clean entries. Not a single candle finished entirely above the 8, and they all stayed under the 20. Also, they all stayed under the 20. Let's take a look at the 2 minute and see what the 2 minute looked like this morning. Look at this. Look at the 20. Look at the 8. I mean, that's much cleaner. The 8 on the 2. Wow. Fall in at the 8. Fall in at the 8. Basically, fall in at the 8. Now, by the biggest problem is, by the time you notice it, it's already too late. It might be, but sometimes I see DWIN saying this is probably much lower, and the stock drops $5 more, or $2 more, or $3 more, or $10 more, meaning it's not too late really. So oftentimes, yes, it's going to be really late, but at any point here, like let's say, okay, now you're thinking, wow, this is power trending, looks pretty good. Okay, over here, so at or near the 8 short, just at or near the 8 short. Now I can't short, and now I probably should be looking to take some. At or near the 8 short, and any kind of a big drop in your favor, take some for sure. So either the 8 or the 20. I prefer to use the 20, but let the stock tell you what moving average to use, which moving average it's respecting. Okay, not very easy, but nothing really is. So practice makes perfect, but nothing really is easy. No single setup is easy. Do what you gravitate towards, do what you really like, and ignore the rest. You don't have to be an expert at everything. Just focus on what you like and then, you know, try and stay away from the rest of the stuff. And that's why I don't do this one anymore, because it's too stressful to be on the mic or to be running the room and looking for setups and doing level 2 and also doing something that's moving so fast and so hard. So I don't do this pattern anymore, but I used to do it. Okay. Any other questions at all? Any other questions? Let me know. Just took a sip of my cold tea here. Go for it, Edgar. Go for it. Take your time. Let's close out of this. Today is April 4th, so April 10th and then April 11th. Got it. The next two coaching sessions, April 10th, April 11th. Waiting for Edgar. Yes, sir, you mentioned mark to market for tax reasons, not asking for tax advice, but can you explain the difference? Yeah, no problem. So mark to market means you get no wash sale adjustments. The replay for this video will be as soon as we finish. It'll be I'm already broadcasting it, but as soon as I save it, it'll be in your customer portal. Okay. All right. So what's mark to market accounting? When you file mark to market, you have to attach a letter to your 1040 when you file your tax returns, and letting the IRS know that going forward you elect to use you're electing to use mark to market. You can't use it for the previous year, meaning let's say for now the taxes or tax returns are due for the year 2022. Too late. You can't file under mark to market accounting for 2022. You can only file 2022 mark to market going forward, and you have to attach this letter that I'm about to tell you about by April 18th, which is I think the filing deadline. So what you say in the one paragraph letter is I hereby elect mark to market accounting for my starting with the tax year 2023, and you put down your name, social, and you sign it. This is what I did. Okay. I don't know if I can show you the letter that I wrote when I did it, but I'll show. Let me see if I can find mark to market. The problem is I don't store anything on my in Windows. I store everything in the cloud, and so when I try to do a search, it's really a pain in the, Windows can't find anything that I want to look up quickly. So I'll just go to my folder here. No, that's not it. Okay, but let me see. Just want to make sure. Okay. All right, so let me see if I can show you the letter. I found it, but okay, there it is. So here it is. Okay, this is the mark to market letter that I wrote to the IRS. Let me just zoom in a little bit. Not zoom in, adjust zoom in. There it is. That's what I wrote to the IRS. This is for 2016. And signed it, and then above here, which I'm not going to show you, is my name, my address, my social security number. I hereby one sec, zoomed in too much. Okay, here it is, maybe clear, easier to read like that. I hereby elect to use the mark-to-market method of accounting under section 475F of the Internal Revenue Code for my securities trading business beginning with the tax year commencing January 1st, 2016. Got it? So that's what I wrote. And I attached this letter. I put it on this was the first page in my tax return, 2015 tax return. So what this does is and then once you do this, you also, when you open an account, or if your account is opened already, you have to send this letter to your broker. So I had to give this to TradeStation, to E-Trade, to the different brokers that I use, and they have to like code your account manually, so it might take a couple weeks. Okay, so but after you go to market, two things happen. No more wash sale adjustments. You don't have to worry about wash sale adjustments. The broker will not even report any wash sale trades on your 1099 because it coded your account as mark to market, not cash, not a cash accounting. And then the second thing that happens is anything you hold at year end will be marked to market, meaning, let's say you hold 1,000 shares of Tesla and Tesla closes at $200. The system will pretend like you sold it at $200 and January 1st you bought it back at $200 if you're still holding it and you didn't sell it. So it marks open positions to market as though you closed out of them. And unless you open a separate account, and in the title of the account you call it Sami Abu Saad's long-term trading, and you specifically ask the broker not to use mark-to-market accounting, that they use cash accounting for that account, and you can open trade in that account any long-term plays that you want, and they will not be marked to market, but they have to be separate from your other accounts if you have other mark-to-market accounts. So that's the benefit of the mark-to-market accounting. I did it because I had to do it at the time, because it's too long of a story. But with wash sale adjustments every year where I was trading, which was Legend Securities at the time, every year they overstated what I made. And so, every year I was like, I clearly made this much money. Let's say 100,000. Why is the 1099 showing I made 130? Well, because of the wash sale adjustments. And I had to explain to the broker, the wash sale adjustments, when all said and done, the net effect should be zero. It shouldn't distort what I made. And I had to write a letter and enclose a lot of documents to show the IRS that I wasn't cheating. The broker was wrong, and they told me, you want to deal with this once and for all, go mark to market, and I did. That's why I did it, basically. All right. So, but I just want you asked, I answered. It's not tax advice. Talk to your tax accountant. I'm just answering the questions, but I'm not giving any advice. Okay. Okay, Maggie, you have a question. Can you go over your target on a long? In the past, you went over target 1, take profit on half. Can you explain how to determine target 1, target 2? It's too long of a topic, Maggie. But basically, what I do is first, so if the pattern is a pullback pattern, if it's a buy setup pattern, then by default the target is the prior high, somewhere near the prior high. But okay, if the play is breakout and there's nothing to the left, there's no reference points, then you go to the larger time frame, such as the daily, and see where the resistance is, and you use that as your target. But ultimately, whether it's a breakout pattern, pullback pattern, ultimately the way I determine target is by assessing how powerful the play is, compare it to how the resistance. how strong the resistance is. It's like, you ask yourself, is this a Prius running into a brick wall, or is it a Mack truck, a semi-trailer running into a wooden fence? So you try and figure out how powerful the play is that you're playing, and you also assess how strong or weak the resistance is. Now, normally, if you're doing a pullback pattern, so here it is, and comes in, and now your target is a prior high. Or even if it's not a pullback pattern, you're doing a breakout, but there's that resistance up here, right, where the stock pulled in from, right? So you assess how strong the resistance is based on a lot of things, such as the more candles at the top, the stronger the resistance. You want V pivots, not rounding tops. The bigger the candles, the more volume they form on, the stronger the resistance. Therefore, you should definitely look to take it up here and not look for more. The faster the stock pulls back, if it starts from wide range bars, the more resistance there's gonna be. Because if the stock pulls in really hard, really fast, it doesn't give people enough time to get out of it. And therefore, on the way up, they will get their money back and get out, right? And then also, if there's any failure patterns, like if there's a breakout failure or any kind of failure, then for sure that's going to be resistance. I mean, a lot of resistance. So take it. There's another way to determine targets, which is if you get into a play and you notice the play is just, it is really beautiful. Every bar never takes out the prior bar's high, and it's just nice and controlled, a lot of momentum. You just go bar by bar. You use a trailing target. And so as soon as you get 2 green bars in your favor, that's as soon as you can do it. You put your stop under the last bar's low. Once it closes, until you get out. And sometimes you'd be quite surprised because you initially thought that your target was going to be here, and the play ends up taking you way up. You end up making a lot more than you expected. So you can use a trailing target, or you can use target based on resistance or support if you're shorting. In order to use, if you're gonna use the target based on resistance and support, then you have to assess how powerful, you have to determine how powerful the play is that you're taking versus how strong the resistance or the support is. Does that make sense? To figure out what your target is. So as you can see, it's a little bit, it comes with experience, and I get it wrong half the time still. So it's not that easy to really figure out where the target is. And the other thing that's not easy about it is, you might think, well, the target is the prior high and the stock starts to come in a little bit, and you might think the target is up here, but the play starts to come in a little bit. What are you gonna do? You're gonna get out most of the time, even if you weren't trailing it bar by bar, because it's like is what happened with me with TECK yesterday. Just yesterday. Okay, here's the pop. Was that it? And then, no, I was out right here. And then boom. And that was really the target. I got to the target. But why did I get out? First, I wasn't too convinced that it was good. And then I had a nice pop because I got it actually over here, over 60, I think. No, 46, over 46. So it was a nice move, and I don't know. Market was weak until it popped towards the end of the day. And so I got out here, and then it actually got to the target, but I wasn't in it anymore. So what I'm saying is, so oftentimes, a lot of times, even if you get the target right, you might not be able to manage it right. Okay? All right, let's see. Okay, I'm considering market to market, but the 3115 needs to be within the tax, with the tax from date. I mean, Donald, your English is way worse than mine right now. Is it appropriate to ask for anyone that has filed for their experience? So it has to be by 4/15, or this year I think it's 4/18. It has to be, even if you do an extension. That letter has to be sent in with the extension. So that letter has to be by the tax deadline for that year. Okay? And then once you go mark to market, you can revoke it too, but you have to wait usually 5 years before you can revoke it. So be careful about going mark to market. Be careful. Another benefit to mark to market is it's not your gain and loss is no longer part of Schedule D, which means if you ever have more than a $3,000 losing year, you can deduct the whole amount. You're not limited to $3,000 for that year. Does that make sense? So that's another benefit of mark to market, is you can deduct the whole loss that year. Now, if you say, well, no, I don't have any income, I'm retired, I don't want to deduct the whole thing that year because it doesn't benefit me, and I just want to have $3,000 and carry it forward, then you shouldn't do mark to market. So again, it gets a little tricky, which is why my only advice to you is spend a little bit of money and talk to your tax accountant about it. Okay? All right, Dan. So so I answered that question, hopefully. I think you don't have to go to market to gain trader status. I'm a securities, I'm a trader in security. I have a trader in securities status, but I think you don't really need mark to market to get that status, which would allow you to deduct expenses. I don't think you need it. But you get away, you do away with wash sale adjustments, and you're no longer limited to the $3,000 maximum loss, capital gains loss for the year. Okay, all right. UNH monthly buy setup is weekly sell setup failure good enough to enter long. Okay, let's take a look at it because I gotta run. It is 12:30 a.m. my time, but let's take a look at it. So I'm sorry, monthly buy setup, weekly buy. I'm sorry, weekly. Yeah, monthly buy setup. So, okay, it is a monthly buy setup. Looks really pretty, but deep pullback. The weekly is okay. So the weekly. So the question is it a sell setup failure? And I would say it is. The problem is I always like it when the sell setup failure happens right when the 20 is right there, so that you can play long above the sell setup failure. But that is a sell setup failure, correct? In which case you can actually, the entry should have been right here, but then you would have been also into the declining 20. But that's the entry. That should have been the entry. Stop right here, or since it's about the same, right there. Okay, on the UNH. But again, in this case, it's not perfect because the 20, usually it's gonna be right there, in which case when you play the sell setup failure, you're actually entering above the 20 on the smaller time frame. Okay, so it's not perfect in this case. Let's see. I've never filed the 3115 form. I've never done that, so I don't know what it is. I know nothing about the form 3115. Thank you for the explanation. The market allow you to benefit from losses when buying and selling the same security multiple times. Is that correct? Correct. You don't have any wash sale adjustments anymore. All right. Okay, guys. Hope you enjoyed today's discussion. It was all over the place, especially with that piece about the tax return thing. But hopefully you enjoyed it. We'll talk in the morning. All right. Thanks so much. Have a nice evening. And I'll speak to you in the morning. Take care.